It's a great time to be in real estate. And,
Yeah.
and I honestly mean that. We've been pleasantly surprised by the degree of activity that we're seeing as folks look. And what's driven it, even on the corporate M&A side, what's driving it is folks want to figure out how to take advantage of the market environment. And they're ferreting through how to do that.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. I am excited about the following shows with this guest. She brings a lot of experience and expertise. Unfortunately, we can't get too often on the show. We're trying to find people just like our guest today. Just so you know, we are working hard to bring this level of expertise to you, the listener and the investor. But our guest today has just that. Her name is Deborah Smith. She's co-founder and CEO of the Center Cap Group LLC. She heads strategic capital and M&A and execution. Previously co-head of M&A and senior managing director of CBRE Investment Management. She joined CBRE in July of 2007, co-head and built out the firm's M&A efforts from 98 to 2007. She worked on mergers and acquisitions with Lehman Brothers, Wachovia Securities, and Morgan Stanley. She's been involved in more than $100 million of mergers, acquisitions, and restructuring transactions. She has a bachelor's in economics with honors and a bachelor's of law with honors from the University of Sydney. She brings so much experience. I love these conversations. You're going to hear a segment of shows, 3 shows actually, that we're going to dive into a number of things. And obviously, she was in business, or she was in this industry during 2008, right? In this business, her CenterCap LLC started in 2009. She's going to talk about that, some of the challenges then versus now. We're going to talk about the capital raising environment in another segment. We're going to talk about institutionalizing your business as well. I just feel like whether you are a passive investor, whether you are an operator, you're going to learn a lot over the next 3 days with Deb Smith here. I mean, she just goes in depth about those things. And I love some of her questions, even at the very end, just more of a personal level. I love drawing some of those things out from individuals that are performing at a very high level, just like Deb is, but don't normally get asked some of those questions, right? And so I hope that you enjoy the show, because I know if you listen the next 3 days, you're going to learn a lot. Welcome to the show. I've read a little bit about your background, your resume, and I'm excited to get to speak to you. And I know the listeners are going to learn a lot from you today. And so I want to jump in. But before we do, who's Deb Smith? Give us a little bit about your background, Deb, a little more than what I was able to elaborate on from your bio. But how did you even get into this business and to where you're at today?
Sure. So I'm a veteran at this point. I've been in the banking industry for 25 years. I think is my 25th anniversary this year, which I think makes me a lifer at this point. And there's not much of my starting class that I started with at Morgan Stanley still around. But I grew up at the bulge bracket banks, originally focused on power utilities and oil and gas, and then fell into real estate in 2005 after I moved to Wachovia, and from there moved on to Lehman. So I've got the bulge bracket banking upbringing, which I'm very grateful for. And then I went over to CBRE and I ran their global M&A business for a couple of years before starting up shop ourselves as a boutique investment bank focused only on the real estate space, and which I think has given us a unique combination of services that cover the whole spectrum of the real estate sector.
Wow. Yeah. Elaborate a little bit on Center Cap Group right now, and what you all focus on there.
So we've been around since 2009, coming out of the GFC. Rightly or wrongly, or smartly or dumbly, we decided to start a women-owned firm coming out of the GFC in an environment where there was no credit available. So we can debate the intelligence of that decision, but we're still here 15 years later. And again, here we are, another credit credit challenge market. And the world parallels from when we started. I think we've gotten older, smarter, know a lot more people, and have done a lot more deals since then. But we originally were doing single asset raises when we started and working on smaller investment management, M&A. And over time, we now work on a lot larger transactions with investment managers, still doing M&A, We've now gone from single asset raises to programs, SMAs, as well as private placements. We've grown all those things out. And then we have a consulting business that's pretty active on advising companies how to grow, whether it's reorganization, succession planning, valuation work. But it's essentially a catch all for anything that doesn't involve a transaction. So we've grown over time. But once again, we're in a credit challenge market. But at this time, we're a lot stronger by foundation. We're a lot more active. We have a lot more relationships, and so it's a good place to be as opposed to when we started.
Yeah, let's jump in there just a little bit and talk about that credit challenged market a little bit. I know so many of the listeners ask often about, right now what's happening. This credit challenged market. What does that mean? And but I would really like to hear, your thoughts. You started it in the real estate sector 2005, and you talked about starting CenterCap in 2009. But talk about that lessons learned then and how you see it from then to now. I know people always wonder about obviously 2008, 9 compared to now and things that you're seeing happening, just with your level of experience. I would love to hear just some comparison thoughts there. What was happening then compared to now?
I think now going back, let's just take both from a capital raising environment as well as from a corporate environment, because they're two different decision trees. On the corporate side, we have never been as active as we are right now. Our busiest year is probably this year, and that was only last year was our busiest year until then. And I think relative to 2009, the market had come a little bit more to a standstill. There was not as much going on at a corporate level, much not going on an asset level, a program level. It was just that the market was tight, not a whole lot was happening. Today, the market is incredibly active, and more so than any time I've seen it in the past 15 years, particularly at a corporate level. And in part, that's driven by the real estate space has gone through a bit of a shakeup in terms of the number of folks that are crossing over into real estate and real estate crossovers elsewhere. So you're seeing massive crossovers, asset management, firms with real estate, insurance companies with real estate, RIAs with real estate, institutional investors with real estate. And so they're coming from the infrastructure background. So there's a lot of drive and things that are driving growth within our sector right now as folks look for alternative ways to access distribution and product. And I think that the options folks are looking at now is a lot more flexible, a lot more adaptable, a lot broader than any point that I remember being in this industry. So that's at a corporate side. On the capital raising side, the market has gone through quite a shakeup over the past 2 years, and there's definitely been winners and losers. We all know the challenges of the office sector, but for anyone in real estate, that's not new news. It's the office market has been challenged since the GFC, so I'm not sure it ever quite recovered to begin with. And then the other segments, it's a niche play. Every sector is active and not active at the same time, depending on the specific segment of that product we're talking about and the location that we're talking about. Because at the end of the day, real estate is a local market business. So people make generalizations constantly about our industry. And for the most part, they're a little inappropriate, I think. But it's what people do. But there are some just general trends that I think have come across that are uniform coming out of the past year, just with some nuances that have favored pretty much cash flowing type product classes or types of deal. And so that's different than a couple of years ago, whether it's total return, absolute return, and annual return. And those three things mean different things at different times and have a greater emphasis at different times. So it's a very active market. Depends on who you are and what you're doing.
Who you said depends on who you are and what you're doing. I know so often right now, I find a lot of the operators I'm speaking to are saying, "Well, we're just not doing anything right now, right? We can't find proper debt or we just can't make deals work." But you're saying you all are super active right now. What's the difference? What's the activity that you all are seeing and doing?
Uh, Across products, we tend to bet on where we think the market is going from a client selection. And where we get the benefit, unlike the operators where they've picked a niche or they've picked a lane and they've got their certain markets, we have the ability to choose clients and pick products across industries and locations and types of deals that we think will stick in the current market and that will be attractive. And I think, for example, multifamily has always been a favored class, but right now it kind of depends on what property we're talking about and where it is. And then there's the conversation, well, if you're a multifamily owner operator or if you're a property manager, those things, there's a real market for those right now. It's a very active market on the service provider, particularly in the multifamily space. And same if you're an investment manager and you're managing properties and you own operate properties in the multifam space, then you're still a hot commodity. So it just depends. But on retail, would you want to look at malls? No. But would you look at grocery anchored or community revitalization projects? Sure. It kind of it really depends where it is. But and then I'd say from and that goes all the way up the chain, whether it's asset level, a portfolio level, and a corporate level. So yeah, but multi-family has been the favored class for 15 years, as long as I've been in the space, and everything else has gone around. But other things have popped up: industrial outdoor storage as a segment of industrial, self storage, cold storage, affordable housing, senior housing. It just depends. Workforce housing. Then condos are tougher. They have a 2, 3 year span. And so it's harder to get those in any market when there's uncertainty.
Yeah, no doubt about it. Led me right into this, and I ask most people on the show this, especially with your level of experience, just what you do see happening right in the next 5 years, and how that is directing our decisions. Because everybody says, "Well, I don't have a crystal ball with you," but yeah, the things we believe are going to happen direct to the decisions that we're making as operators and as business owners. And so, how, what are you? I guess let's back up there a little bit and say, where are you getting your data from? What are you trusting, for the data you're using? And then what do you believe is going to happen that's leading you to believe these locations are going to be best or this asset class?
Yeah. So all of our data comes from who we talk to.
Yeah.
So where we traffic in dialogue and conversations and relationships, given our model of having institutional investors can be both clients and counterparties. And then you have the users of capital, which is everybody else. So owners, operators, property managers, investment managers, they're users of capital and they're our clients too. They could be on the buy side, sell side. So when you sit between them, you get a really unique perspective of what is going across an industry in general. And so that helps guide. So, for example, coming out of COVID, we had the conversation, which always, as you know, real estate's an IRR driven business and people are focused on, well, what's my return and appreciation, et cetera, et cetera. But what we found coming out of COVID is that the conversation has shifted to cash flow. So it's yes, IRR is important, but what's your yield? What's my yield on return? Do you have a positive leverage or a negative leverage product? Right. So, and that's what institutions now looking. So they're buying concepts from core asset land that if you're going to look at a value add, well, okay, well, what's my cash on cash for that year? And are you buying it at a negative leverage position? And so, and then you have other folks that even if it is negative leverage, will still look at that because they're buying it all cash. And why are they doing that? Because they believe the properties were below replacement value. So they think they're getting a bargain. And so there's a lot of different nuances. I think it depends on how much pricing has corrected. Pricing has come down across the board. And so I think people are willing to lean on things as they look at cash flow and they look at replacement value in determination or looking at their individual deals. So, and then when you take from that perspective, you start looking around, well, what are all the cash flowing sectors? Right. And you go from there. And that's what we've done. But it is the world of the niche outside of multifamily. Niche products are a class where folks, why are they looking at them? Because they're chasing yield. Right. And what's a niche product? Well, and a lot of things niche mean it is not entirely institutionalized. And so there's a lot of fragmentation, it's still very fragmented, allows for arbitrage and capture of alpha that's simply created by the market dynamics. And so in that world, niche generates cash. And so that's why there's some focus on those things. I throw manufactured housing in there as well. It's RV parks, um, parking, car washes, anything like that, where it is not an entirely institutionalized market is in there. Actually, I forgot single family homes is the other one, is where there's a lot of attractive and there's a lot of interest. still now, and whether it's from a corporate perspective or from an institutional capital raising perspective.
So you all are interested in all those asset classes you just mentioned?
Yeah, we tend to focus on we look at every project as it stands on its own. And we look at who the manager is. We look at what they how they spend their day, what their track record is, and whether it's an even if it's a corporate level transaction or it's raising capital down at the program or the project level, we underwrite them the same. Who they are they good at what they do? Are they institutional? And can I raise institutional capital around them or can I sell them because they're institutional? Or are they looking to consolidate themselves? It's a lot of the same skills underwriting your management team we still look to. I mean, obviously the difference is that if you're raising capital, people will look to the projects more than because they can see, touch, and feel it. And if you're selling a corporate, they're focused on the quality of that management team and their ability to run and build a business.
Speak to the, location dynamics of the locations you all are focusing on for the next 5 years.
Well, from a manager corporate level perspective, it matters a little less. It's what their product that they're focused on and what their performance is. On an asset, if we're raising institutional capital through private placements or programs, no, you can't beat the Southeast right now. Anything in the South, it's favored asset classes. I think coming again, it was even before COVID, but what COVID did, similar to the tax changes across the US, is it's made certain markets less attractive than others. And COVID really emphasized, in some ways, tax differentials because there was another thing that was piling on. Are you indoors? Do you have space? Now paying high taxes. And so all of those things, you throw them into the mixing bowl, and there has been mass migration across the US. And what that really means to someone in the real estate space is that people are moving, which means they need somewhere to live. People going to stores and grocery stores. Which grocery stores are they now going to? How are you going to get them this stuff in the grocery store? So now I need to deal with logistics and industrial. Are they going to go to work or not? Well, now I need to figure out where these people are going to go every day. And so it goes round and round and round. But simple population migration has a big impact. And then who's moving and how much money do they make? And so you throw those things in and it's so coming out of COVID, in some ways, it's a terrific thing for real estate because the market had become so efficient. And now there's a lot less efficiency as people figure out where all those things, the answers to all of those questions. There'll be winners and losers. Some will get it right in some way.
You mentioned probably a few there, but I wanna ask just what do you see as the real challenges, right, for commercial real estate sector moving forward?
Well, right now credit is tight. And again, it depends on which sector you're in and the asset. So it's always tough to make generalizations. But I think most people, interest rates have moved up, which has made the cost of financing more expensive, which means it's harder to pay for anything because of that cost increase. And the challenge with that is where you still have strong performance on assets and you still have strong performance in sectors and markets. It's how do you bridge that spread where you have sellers who still think that well, my performance is good. Why shouldn't I get the same price I did before? And you have buyers saying, well, because it costs more. I can't pay what I paid before. And it's bridging that difference and finding the happy medium. Deals are getting done even at an asset level. Cap rates are still low depending on what it is and where it is, and depending on obviously the product. But we're seeing still double digit bidders show up for properties depending on the asset class. And yet for others, you can't get anything. You can't get anything done. And you would think, well, why not? Because it's a great property, it's a great asset, it's cash flowing. And some of it is just driven by as investors recalibrate their own focuses and they're balancing allocation issues themselves with declining real estate values. And so you have that extra challenge that we didn't have a couple of years ago. So collectively, looking at migration changes, looking at changing in financing, balancing decreasing real estate valuations on portfolios, all of things mixed together. Some people are willing to push through that and take the risk and still do things and get things done. And some will be sidelined. But there'll be winners and losers out of who was right on that too.
What would you say is gonna be the deciding factor of the winners and losers over the next 5 years?
Whether interest rates settle, when interest rates settle and where they settle at it will be a big determinant is my guess. Folks that made bets on markets and products that others weren't willing to make. Sometimes institutions can follow other institutions, and sometimes it's not always the right answer. Sometimes it is. But I can tell right now, one area where folks are making bets is in the private credit space, and private credit managers and offering debt products is something that's increased, and it's got greater visibility and popularity now than the last time I see this much interest in acquiring credit managers was the GFC,
Mm.
when we kind of had the growth of the mortgage REIT industry. And so we're seeing some replications of that as folks look to figure out how to play in the credit space, because with interest rates where they are, we now have to compete with interest rates on debt. And so if you're charging above on a floating rate basis, there is the basis to be able to charge and create great alpha just on credit strategies now without taking the risk on the equity side.
What's your expectations for interest rates? What do you expect to happen? You talked about that's gonna, I mean, that's gonna make and break so many businesses, I feel like, right? But what's your expectation?
Yeah, I wish I knew. I think what the folks are looking at doing now is some of the folks we're dealing with on the investment management space are looking to take out fixed rate, even if it's on where interest rates are, and locking down and underwriting with that in mind. And so, therefore, they can at least lock it in, being able to manage through that. And so, and on a floating rate basis, I read the journal on the weekend like everybody else, and I don't think anybody has the answer as to where it's going. I think there's a lot of support for an argument that the recession, it may not be as deep as long as folks thought, which is obviously a positive. And if the broader industry buys into that, then optimism will be enough to push people to become more active.
Yeah. Wow. So much to happen and see what happens over the next 6, 12 months, right?
Look, it's a great time to be in real estate. And
Yeah.
and I honestly mean that. We've been pleasantly surprised by the degree of activity that we're seeing as folks look. And what's driven it, even on the corporate M&A side, what's driving it is folks want to figure out how to take advantage of the market environment. And they're ferreting through how to do that. And some obvious things is private credit managers are very popular. Multifamily managers are popular. Property managers are popular. There are certain things that people are trying to bolt on in order to grow their business because they perceive, for example, that there's a housing crisis in the US. People, I think, generally believe there's a housing issue. But what does that mean? Well, it depends on the market, right? It's a generalization, but how you play that depends on who you are and where you are. But what it does do is put a spotlight on the importance of affordable housing, workforce housing, people who manage housing, people who are investment managers and manage on behalf of institutions. Being able to get closer to the property is really change and emphasizes the value of being in that vertical, right? So there's that space that's very popular. I talked about credits, another one. Self storage has been popular for a little while. Single family homes for rent's the other one, where we were first pushing it as an asset class 10 years ago. And people weren't so interested in listening to me back then. Now they're listening. And so, but again, it's getting at there's a housing shortage. And so you have a lot of folks gravitating towards the space, trying to figure out how to address the housing crisis, but in so doing, make money.
Yeah. Wow. All right. Yeah. But unfortunately, we're going to move to a few final questions of this
Sure.
segment. And just so the listeners know, we're going to do another segment with Deb and dive into another topic as well. But what's been the maybe or a big challenge that you all have within the business right now?
Oh, this is the easiest question you've asked me all day. It's finding people to work. We've been growing. We've opened up an office in Florida and we're based out of Stamford, Connecticut. It's hiring good resources.
Yeah.
So as a boutique bank, we don't get hired. We don't have any lending capability, no research, no sales and training. So the only way we get business is giving good advice and knowing a lot of people and knowing how to connect them. And so that means that anyone you bring into the firm has to represent us and that they're very material to our reputation in the market. And so we take it super seriously on hiring, and it's not easy to do. It's not easy to do.
How are you finding people?
We advertise and we go to the colleges and we have online recruiting. And But again, it's always difficult off that first when off interviewing to make sure you get that right because once you're in the firm, they're there. And what I always tell our junior guys are is let's make our hiring decisions meaningful because if they're not pulling their weight, then you'll be doing it for them. So hire right, and that's we put a lot of trust and we put a lot of responsibility across firm wide in hiring decisions, and so that's because we gotta get it right.
Give us, one of your top tips on how you're getting that right. Because I could talk all day about this as well, and just the
Yeah.
importance of hiring. Is it a type of interview you all do? Is it another type of, skills assessment, or what is maybe something that stands out to you that's like I do this every time, Whitney, that helps us to figure out who that person is, that they're a good fit.
Right. Well, you got to keep in mind we underwrite companies for a living. So our job is to figure out who's good at their job and who's not, and to figure out their management teams we can either sell or we want to work for. So I think we've got that piece down pat. Look, I'm always focused on character. Everything else can be taught, but you can't teach character. You either have it or you don't. And so I'm very focused on that. It's, wanting people that take pride in their work, want to get the job well done, and will work the extra hours so someone else can go home early at night. It's in those things you can't teach, and I can't find it in a GPA, and it's not on a transcript. And so it comes out in your dialogue and how you talk with people and things that are important to you and where you're from and what you're up to. And I think it's more of a holistic approach because there's no grading for character. I remember when I was graduating from college, I did one of those online testing character, and I don't know if I did very well. They probably thought I was crazy, but one thing I can safely say is I think I evolved a lot over time. And I think if people across even Morgan Stanley, I'm not quite sure how I got the job, but because I didn't have any finance background, if I don't know what they saw because I got the job through a conversation. It wasn't off my transcript either. And they saw something. And the irony is that of my class of, I don't know how many was in it. It's a lot. There aren't still many of us in banking. I happen to be one of them. So whatever they did, they certainly got something right.
Yeah, that's awesome. That's awesome. Yeah, I couldn't agree more as far as the character. And I've been hired in numerous positions before real estate that was so important, right? It was so important that they
Yeah.
hired me based on character. I felt like because I didn't know anything about the
I
position.
hire on character. I don't I'm less interested in GPA in colleges, and I don't get me wrong, my business partner focuses on those things, but I'm less so. Like I said, you can't teach it, and you either have it or you don't. And so there's a certain type I've decided is there's a certain type of character that can survive in this industry. It's a tough industry to be in. It's relentless, and so you got to be a certain type, I think, to make it.
Yeah. Is there, I won't keep going on this, but I want to ask you, is
Yeah.
there a way that you assess the character in some way or that you could share?
Look, I ask a lot of questions, just background questions, the stuff. It's actually really interesting is that I find the most interesting things about people are the things that are not on their resumes that they don't think, they worked at Starbucks and they had to put themselves through school and things like that. So people don't think it's important. I think it's important. And so, but I'm probably I think I'm a little unusual in my hiring practices vis-a-vis to the industry, which are focused on grades and GPAs, and we went and all of those things. But I'm not. I'm almost certain that's not the reason I got the job when I started.
I think that's so wise, Deb, to say the least. I think it's such a good way to hire is to focus on character. I could not agree
Character.
more. Deb, tell the listeners before we end this segment how they can get in touch with you and learn more about you.
We have a website at syndicapgroup.com, and we're also on LinkedIn. And you can find me on LinkedIn too, Deborah Smith Syndicap or Syndicap Group. And we should pop right up.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.